Genpact, ticker G, is currently trading at $44.24. That's down about 25 cents on the day, a pullback of just over 0.5%. Now, for most stocks, a 0.5% move is just noise. But for Genpact, this is the most important price action we've seen in months, and it's telling us a fascinating story. Because the expectation, the narrative that everyone has woken up to this week, is that this stock is a rocket. It just gapped up and ran nearly 16% on Friday after its earnings report. The expectation is that the momentum players would pile in today, that the chase would be on. But the reality right now is a pause, a slight cooling off. And this brings up the critical question for anyone watching this stock. Is this a healthy minor consolidation before the next leg higher? Or is this the first sign that the market is already questioning just how real that explosive earnings beat truly was? Let's establish the common ground, what everyone now knows. Genpact, the company most investors filed away in their brains as a boring, stable, legacy business process outsourcer, a BPO, just shocked Wall Street. On Thursday evening, they reported third-quarter earnings that didn't just beat, they completely reset the narrative. The consensus was looking for earnings around 88 to 90 cents per share. Genpact delivered 97 cents. They beat on revenue, posting $1.29 billion against a $1.27 billion estimate. And then they did the one thing that forces every analyst to update their models. They raised their full-year guidance for both revenue and profit. The market, which had left this stock for dead, trading near its 52-week low just last month, had to digest this. The reaction was violent. The stock, which closed at $38.39 on Thursday, gapped up and ran all day Friday, closing at $44.49. That's a 15.9% re-rating in a single session, on massive volume of over 7 million shares, multiples of its daily average. So the expectation is that Genpact is finally fixed, that the growth is back. But here's the reality, the deeper take that today's $44.24 price tag is forcing us to confront. The beat wasn't driven by the old legacy BPO business. That part of the company is still growing at a crawl. The entire story, the whole reason for that 16% gap up, is hidden in the supplementals. The growth came from their Advanced Technology Solutions segment. That part of the business grew an astonishing 20% year over year. This segment is now 24% of Genpact's entire revenue stream. Their data tech AI services revenue grew over 9% and now accounts for nearly half, 48%, of the entire company. This is the reality that contradicts the market's old belief. Genpact is no longer just a BPO company. It is, and has been for several quarters, a stealth data tech AI company, and the market only just got the memo last Friday. The question now is whether a 16% pop is enough to price this in, or if this is just the beginning. The institutional holders, the Fidelity and Vanguard and JP Morgans of the world, who own over 96% of this company, have been sitting on this, and now their thesis is finally playing out. This isn't a stock for someone day trading on the Robinhood app. This is a fundamental story that the big Fidelity wealth management and institutional desks are driving. Let's look at the charts and the recent movement. That gap from $38.39 to Friday's open of $43.09 is what we call a breakaway gap. It's powerful, and it signals a complete change in sentiment. It also leaves behind a massive unfilled window on the chart. Technical traders will be watching this. Today's pullback from Friday's $44.49 close to our current $44.24 is for now extremely orderly. It's trading calmly inside Friday's massive candle. This is what bulls want to see. They do not want to see a rapid gap fill where the price collapses back to $38. This slight pause suggests that the sellers who were taken by surprise are gone, and now the new higher-level buyers are just figuring out their positions. We are seeing volume today that is much lighter than Friday's massive 7 million shares, which again points to consolidation, not a reversal. This is a battle between the old guard value investors who see a PE ratio of just 12 or 13, a bargain compared to competitors like Accenture or Cognizant, and the new guard growth investors who are trying to decide if 20% growth in their tech segment is sustainable. So what does Genpact actually do that's causing this shift? For years, they were the back office for the world's biggest banks, consumer goods firms, and healthcare companies. They ran accounts payable, managed supply chains, and handled customer service. That's the core business services revenue, and it grew at a sluggish 3%. That's the part of the business that investors who are used to the volatility of Apple stock or Nvidia stock find so boring. But while everyone was focused on that, Genpact was quietly building its AI-driven services. They launched a new platform called AI Maestro. They have an AI Gigafactory that is now supporting over 100 clients, a number that doubled in just one quarter. They are aggressively shifting from a model of billing for people to a services as software model. They are automating entire corporate functions. Their case studies show they are using AI to automate accounts payable, achieving 30 to 70% increases in throughput. They are not just using AI, they are redesigning their clients' core processes around it. This is the reality. The expectation was that AI would kill BPO companies by automating their jobs. The reality is that Genpact is harnessing AI to become more valuable, not less. They are selling the picks and shovels and the automation expertise to their massive embedded client list. This brings us to the future outlook. What are the catalysts and risks? The primary catalyst is right in front of us, a massive market-wide re-rating. Analysts are just now scrambling to update their models. The consensus price target before this news was around $50, but many, like Citigroup, were stuck on neutral. We are almost certainly going to see a wave of upgrades and price target hikes this week. That could provide the next tailwind. The valuation, even after the 16% jump, remains the single most compelling argument. A PE of 14, if that's what it settles at, for a company with a 20% growth engine now driving the bus, is still exceptionally cheap. For investors in Schwab Intelligent Portfolios or those looking for online investment help, this is the kind of value plus growth story that is hard to find. It's a different kind of investment than just buying Tesla stock and hoping for a tweet. But the risks are just as real. First, this pullback to $44.24. We must watch to see if it holds. If it breaks below Friday's low of $43.09, the technical picture gets much uglier and it could signal a full gap fill, which would be a 10% drop from here. Second, the macro environment. Are global companies in a high-interest rate world still going to spend on the large-scale digital transformation projects Genpact is selling? The earnings report says yes, but that could change. Third, there are internal risks. The company's SG&A expenses, their operating expenses, were up over 7% in the quarter. They have to control their own costs while they sell cost control to others. And as with any services company, they have risks in employee retention. They are based in Bermuda but have a huge workforce in India and the Philippines, and wage inflation in those regions is a constant pressure, one that AI is supposed to be solving. Comment below with your thoughts. Do you believe AI will be a net positive for Genpact's margins, or will the cost of AI experts and internal investment eat up the savings? So, as we watch Genpact trade here at $44.24, we are at an inflection point. The expectation last week was for a boring, stable, low-growth dividend stock. The reality, delivered by a stunning earnings report, is that this is a 20% growth, AI-driven tech services company that was hiding in plain sight. The explosive 16% jump on Friday was the market's oh crap moment, the frantic repricing of this new reality. Today's slight pullback is the market's first collective breath. It's the moment where the algorithms, the Interactive Brokers clients, and the long-term Fidelity investors all have to decide if the new price is justified or if it's just the beginning. The old story of Genpact is dead. The new story of an AI-first transformation company is just being written, and the market is finally paying attention. Disclaimer: this video is made only for educational and informational purposes. I am not a financial advisor. Any stock, crypto, or investment discussed here is not financial advice. Please do your own research or consult a qualified financial advisor before making any investment decisions. Invest responsibly.